Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek, insight from the reporters and editors that bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
Shares of Apple right now are down about 1.6%. They were higher by as much as 4% earlier in the session, more than 4% earlier in the session. This after the company reported earnings yesterday. Not a lot of great news in the numbers that came out. Some real weakness in China and the iPhone. We're going to talk about all that in just a minute. First, though, we got to talk to Mark Gurman about this Bloomberg News exclusive that he reported just in the last couple of hours. Mark Gurman is Chief Technology Correspondent. He joins us from Los Angeles. Mark, you came out just in the last hour with a story about some big news. Apple canceling this sort of Meta glasses competitor. What are the details here?
Thanks for having me. I mean, as we know, the holy grail in the mixed reality industry are augmented reality glasses. And so Apple's been working on this for some time. Obviously, the Vision Pro, it's a technical and engineering marvel, but a commercial failure. Even the people who paid $4,000 for it really aren't using it. So looking for the next big thing in the MR space, and that is AR glasses. So the original vision was a lightweight pair of glasses that you connect to the phone, use the phone's chip, use the phone's operating system to power some of it, the battery. That had too many technical hurdles to overcome. So they pivoted to making Mac glasses, so AR glasses that you can connect to your Mac. Obviously beefier battery, more processing power, additional engines for graphics and AI. But now they've pulled the plug on that. Apple is abandoning Project N107. That's what they call it internally. That's their augmented reality Mac glasses. And now back to the drawing board. They need to figure out a future for this platform. They've spent tens of billions of dollars investing in augmented and virtual reality, the whole XR pipeline. Right now, I would say this is not great. They're lost, and it's not good. It's not good, especially when you realize how behind they are in AI too.
Well, it's funny because we were talking about this with Caroline Hyde yesterday. Like this could be, I was saying this could be an option for them because Meta glasses have been somewhat successful. I mean, they're not selling off the shelves, and they're, it's still early technology. And Caroline made the point, well, Apple's not necessarily first. And Carol made this point too. Apple's not necessarily first to stuff, but oftentimes they're best to stuff. So I assume that yes, they would come out with some sort of wearable piece of eyewear that would really change the game. Does that mean they're just done with this?
We're talking about two different things here, right? So we're talking about augmented reality glasses versus smart glasses, right? So the Meta Ray-Ban glasses, those don't have displays, those don't have augmented reality, right? Meta's not going to have AR glasses on the market until 2027 on the earliest, so we're still 2-3 years out from that actually happening. Now, I do think there is a world where Apple could come out with some fashionable glasses that have cameras and speakers and batteries and whatnot built in order to compete with the Meta Ray-Ban glasses. That being said, Meta will be adding a small little display into their glasses next year. It's not an AR display, but it's going to be something similar to what you saw from Google Glass a decade ago. Those are going to be quite expensive. But certainly, this is not a good moment for Apple. I would say this is terrible. I quite frankly wouldn't be surprised if they all but abandon their mixed reality efforts, but also wouldn't be surprised if they pull things together and they try to get a model out in the future. I would say 3 to 5 years from now is the time horizon on Apple standalone augmented reality glasses. So these glasses that we're talking about today are something a little bit in between what Meta has on the market today and the eventual vision, right? So standalone glasses. The glasses themselves, they have the displays, they have the OS, they have the battery, they have the engine. You don't need to connect it to the phone. It's a phone replacement. Apple's is a bit of a mix. It has the lenses, it has some onboard processing power, some of the guts in the glasses, but you're going over a cable and using mostly what's inside of the computer, right? Meta has no displays, it's phone synced. What they're launching in 2027, this is their Orion prototype they showed in October of 2024, just a few months ago, that wirelessly pairs with a puck that you keep in your pocket and a wrist device. And between those three mechanisms, that's the whole operation of the device. But what we really want are fully standalone glasses, and quite a ways out from that.
All right. What's going on at Apple? Because they just, is this just they're having a tough kind of design moment, or what's going on that they are, it sounds like, kind of completely walking away from it?
This is a company that couldn't figure out a self-driving car. This is a company that hasn't been able to figure out AI. this is a company that is not able to figure out AR or VR for the time being. The good news for them is they're still selling a lot of iPhones, and that's going to allow them to keep having money to throw at R&D budgets and try to figure something out. And I think they eventually will, but it's a scary time right now, I think.
I can hear in your voice.
Well, there's a lot of interest for a major new product, and there's it just isn't something. It's about reskinning the existing widgets. They're going to have thinner iPhones, foldable iPhones, all sorts of stuff, smart home appliances, foldable iPads. But in terms of a revolution, we're far from it.
But I mean, what's going on inside? Are they just waiting, Mark, for other people to kind of figure some things out before they kind of jump on board? Or do they not have the right people? Engineers, design folks, like what is it that's missing maybe in the mojo of Apple of today?
They've lost a lot of their visionaries, right? They lost a lot of their top engineering talent over the last several years. It's really about, vision and willing to take bold risks to accomplish the next big thing. They didn't want to take the bold risk of getting a car out, fine. They took the bold risk of getting the Vision Pro out, but that took a little too long, and it was a bit of a failure, at least till now. I mean, I think with the proper marketing, the proper price points, they'll be okay. But at some point, they're going to have to figure some stuff out and make some hard decisions.
You said Apple's still selling a lot of iPhones. We know that, but they're not selling as many as analysts thought they would sell, especially in China.
So I will let's just be honest here, right? Like, the analysts come up with these numbers,
okay.
Right? They come up with these forecasts, right? And then Apple announces a certain number, right? And that either beats the number from the forecasts or doesn't, right? But it's not like you're comparing Apple numbers to Apple numbers. You're comparing Apple numbers to numbers that a bunch of analysts came up with for themselves, right? And so the question is, where are they getting this data from, right? Why do we think that's how many they would have sold? Is it how many they should have sold, how many they thought they were going to sell, right? So I do think there are some fundamental questions about the whole comparison between analyst estimates and what really were sold. I personally think the better metric is how many they sold versus how many they sold in the year prior. Are they showing growth? What percentage of growth would we have liked to see, right? In terms of China, I think that's more of a clear-cut example of their performance, right? They dipped $3 billion year over year. They're down $7 billion compared to 2 or 3 years ago in the holiday season, right? So that's a bit more cut and dry. The China thing is extremely concerning, I think. The iPhone, to me, was actually pretty good.
I mean, they're still selling $124 billion worth of stuff. Like, I always think about this, Mark, when the numbers cross and we all kind of just throw them out there. I mean, they still sell a ton of stuff. That's just a quarterly number.
Yeah, that's a lot. That's a 4% year-over-year growth. That's good, right? I mean, we were at a time period about a year and a half ago. We talked a lot about this, about how they were declining on an annual basis quarter after quarter, right? That was not a great time for them. But now we're back in growth mode, and that's why the stock is up today. It reflects that. They have growth in the holiday period. They're going to grow again in the March quarter. So I think there are positive signs on an overall basis. In terms of the products, I think the Mac and the iPad were sneaky good hits recently. And, we've talked about John Turnus, the head of Mac, iPad engineering, right, being in line to be the future CEO. I mean, I think that we're just keep pushing in that direction by having the mainstays in the Apple product pipeline doing as well as they're doing, right? I think the questions about Apple are the peripheries.
Yeah.
How about that services revenue, though? That came in above estimates.
It was great. Yeah, App Store, cloud services, advertising business at Apple is growing quite steadily, so that's helping on the margins for them too. Obviously, there's some fear around the App Store outside of the U.S. given the regulatory environments, but it even seems like that's tapering down too, right? So services, I think, quite positive. Can you imagine if Apple didn't get into the services business and did that full push into services about 5 years ago, where they would be right now? I mean, that whole initiative has really, I'm not going to say saved the company, because it's hard to save a company that's making $120 billion a year, but it's done wonders for them.
Well, Tim and I talk about, we look at our monthly statements or,
like
how much
iCloud.
I pay out to Apple on the services side, not even on the hardware side. Is pretty remarkable. Hey, there's a couple of other headlines that have come out over the past week or so. Apple and SpaceLink to support Starlink network of iPhones, some different things coming out. What do we need to know about that?
So this is an interesting one. So T-Mobile in the U.S. is now rolling out a beta version of their Starlink partnership with SpaceX. And even though Apple already has its own global network for satellite infrastructure through Globalstar, if you're a T-Mobile customer in the U.S., you're going to have a great experience using Starlink on your iPhone when this rolls out officially in the coming months. And so I'm very bullish on satellite networking, very bullish on the future of satellite connectivity for devices. I think this is going to be a great thing for iPhone customers, but also Apple or Android customers. Why this was newsworthy is because all the disclosures to date is that this would be a Android specific technology, but getting it on the Apple ecosystem I think is great. And so as an Apple customer, I'm excited to take it for a spin.
I'm a Starlink customer. And fully,
I forget that you are.
It's pretty amazing. It's pretty amazing. Anyway, go ahead.
Hey, Mark, just about 45 seconds left. We haven't gotten your take on the DeepSeek news of earlier this week. How do you see that relating to Apple?
Okay, so twofold. On one hand, it validates Apple's model for artificial intelligence, right? But on the other hand, Apple's model for artificial intelligence is not very good, and you have this random small company that nobody ever heard of until last weekend eating Apple's lunch, right? So it validates it, but also shows how far behind they are at the same time. So I don't think it's a great thing for Apple. I'm telling you, Apple needs to figure something out on their AI stuff. I just don't understand how a company this resource rich with the right people in place have been able to just completely miss the boat on the biggest new technology since the internet.
Wow. Well, unbelievable. Like I said, the tone in your voice, I haven't heard that for a while when it comes to Apple specifically. He is Mark Gurman. He's amazing. Bloomberg News Chief Technology Correspondent. Be sure to check out his weekly newsletter. You can find it at Bloomberg.com and, of course, always on the Bloomberg terminal.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
President Donald Trump intends to move ahead with plans on Saturday, tomorrow, to impose 25% tariffs on Mexico and Canada and a 10% levy on China. This was coming from the White House earlier, the White House press secretary commenting on it.
I saw that report and it is false. I was just with the president in the Oval Office, and I can confirm that tomorrow, the February 1st deadline that President Trump put into place at a statement several weeks ago continues. The president will be implementing tomorrow a 25% tariffs on Mexico, 25% tariffs on Canada, and a 10% tariff on China.
All right, that, of course, is the White House press secretary, Caroline Leavitt, earlier today. When she said, I saw that report and it was false, there were earlier reports today that these tariffs would not be imposed until March 1st. So she was clarifying that, no, yes, indeed, it's going to start tomorrow. So certainly something that we're following. We also had some U.S. economic news this morning on inflation, something the Fed, of course, watches very closely. So let's get into it. Let's tie it all together in terms of what it means for the U.S. economy and really the global economy. With us right now is Molly Smith, Bloomberg News global economy reporter. She's right here with Tim and me in studio and out there in our DC bureau where so much news is coming lately. Bloomberg News global economy reporter Enda Curran. Hey, Molly, I do want to start with you. We did get inflation data. We got a read on consumers in terms of spending, incomes, and yet this is all against the backdrop. Like, I don't know, do we not even care about any of that anymore because tariffs are now front and center?
It really is. I mean, I honestly even was forgetting that we already had PCE this morning. So much has happened since then.
Good point.
So, and of course, this data for PCE is back in December. So, I mean, tomorrow, February 1st, December is really old news right now. And we also kind of had a good sense of how this data was going to come in because we got the GDP data yesterday, which is quarterly and wraps a lot of this stuff into it. So not too many surprises coming out of the December data, but just wrapping up what we had a sense of, that inflation is, well, maybe coming down depending on how you look at it, but in a lot of ways still moving sideways. And consumer spending, tough to bet against the consumer, even if it looks like there are signs that disposable incomes are slowing and the savings rate is dipping. So reasonable to think that, consumer spending would start to slow, especially if tariffs are enacted, if that is meaningfully going to increase consumer prices. But it's just really hard to bet against the American consumer. That's a tale as old as time.
And good that we have you here with Molly Smith. And you look at the global economy, you look at the U.S. economy, tariffs, 25% on Mexico, Canada, 10% on China. I mean, these are the U.S.'s largest trading partners. There's a lot that goes back and forth. Your initial read on if this sticks around for a while, what it could mean.
Well, certainly a big headline out of the press briefing in the White House. Even though the president has warned about these tariffs, imposing them tomorrow, February 1, I think is probably at the shock end of the scale for most economists. But still, we have to wait and see, to your point, just what exactly are the details in this. The press secretary did say it would be 25% on Canada and Mexico and 10% on China. But we need to know, are we talking about all of the goods, the merchandise goods across the borders and come in from those countries? We need to know, will there be any exemptions for some sectors? How long will these tariffs be in place for? I mean, will there be mitigating circumstances where Canada, Mexico and China can plead their case? So there's lots of, devil in the detail on this, but taking it at face value, it would be quite a shock, because you're talking about, everything from food, avocados, my colleagues wrote about today, lumber crossing the border from Canada, cars and car parts go back and forward on both borders. And then, of course, when it comes to the US and China, I mean, obviously China is the world's biggest trading nation. They're the factory of the world. So, the whole gambit of consumer goods will be coming in from that side of things. Now, you can argue the toss about how much of an impact 10% would have, but I think the bigger focus I think right now is on that 25% level, Canada and Mexico.
Well, to that end, and I'm wondering who you think absorbs the majority of these tariffs, especially those from Mexico and from Canada. Does it, in your view, happen that it's the consumer, or is it the company where it eats their bottom line? Who absorbs more here?
So there are a few parts in this chain. Number one, the question becomes, will the exporter or the producer selling their product cut their prices to factor in the tariff? That's one side of it. The other side of it is, will the buyer, the importer, absorb the tariff rather than pass it on? If they have good margins, can they take the tariff on board rather than pass it on to consumers? But to your point, and this is where economists say the rubber hits the road, in truth, these companies don't have those margins. Nobody's going to take a cut in their selling price, so these prices will eventually be passed along to the consumer, pass on to Main Street. Now, the Treasury Secretary, Scott Bessent, made the point recently in his hearing that there are mitigating circumstances. He made the point that the strong dollar can offset the impact of tariffs, and he said consumer patterns will change anyway. They won't buy tariff goods. There are ways around this. But, writ large, there's a question mark for sure over the impact of prices for consumers from tariffs.
I do want to point out the tariffs would mark the first wave of trade levies in Trump's new term, and their impact will ripple well beyond Canada and Mexico as other nations brace for the possibility that they may be targeted next, and as U.S. businesses await possible retaliatory measures. And this is the one thing that it maybe stops business from kind of moving ahead on something as they try to figure out the impact of it. Molly, I want to bring you back in here, because how much can the U.S. economy absorb if there is a bit of a tariff war or trade war here? And is it more of an impact on growth, or is it more of an impact on inflation?
Well, that's what we had a story out this week that was just examining that exact question. And the conversation this time around really has been about inflation, but that's because inflation is, of course, has dominated the conversation for the last couple of years here, versus in 2019, the first full year after Trump's first term tariffs were enacted. The inflation, quote, problem then was that we couldn't get up to 2% inflation, that it had been running so low for so many years coming out of the financial crisis. So it's a very different conversation now versus back then. What was really the concern that was starting to unfold was looking at how growth is starting to slow down in response to tariffs, how business investment is stalling, industrial production is contracting, those factory jobs are actually not coming back here, and how these are then going to be headwinds to growth. Of course, that all got very soon overshadowed by the pandemic, and we didn't really get to see the full effects of it play out. But it's a good lesson for this time around, and that's what our story was looking at as we just recently got new transcripts from the Fed. These are verbatim closed-door accounts that come out with a 5-year lag from those meetings that were in 2019. And we saw that it was really more the growth concerns rather than inflation that dominated the conversation back then.
Well, speaking of the Fed, there were a lot of questions, Molly, to Fed Chair Jay Powell earlier this week about Trump's proposed policies. And, just to paraphrase a little bit, he basically said, well, we haven't seen the policies enacted yet, so we can't really comment on them. We don't have a roadmap for them necessarily. now at the Fed, they have their work cut out for him because they know that these tariffs are starting tomorrow. How does it change the conversation that they're having?
Well, I think the flack that honestly Powell has gotten, from economists who have commented on this since the Fed meeting on Wednesday is that the Fed, communication up until Wednesday was we are data dependent. We're going to wait to see how economic data evolves, and that's going to guide our policy and how we think about the economy. But the message that a lot of people heard on Wednesday was we're going to wait to see what Donald Trump and his administration does, and that's going to guide our understanding of the economy. Those are two very different things, and it's still just, again, as Enda was saying, devil in the details. Like, there's just still so much unknown with that. And of course, how much the data of that is going to pick up as well.
Enda, and it makes me wonder about kind of this Goldilocks economy, perhaps, or just right economy that President Trump inherited in his second term. You write about it in the Businessweek newsletter, BW Daily, that is out on the Bloomberg and at Bloomberg.com. I mean, he came into this second term with a lot of things doing really well.
Yeah, like Molly was saying there, you've got a very strong consumer base at the moment. You have strong aggregate GDP. The labour market is cooling, but still in pretty good order. The Fed chairman himself, Jerome Powell, said this week that the economy is in a good place. Of course, the question becomes what sort of a balancing act President Trump faces. On the one hand, he wants to go ahead with these tariffs. How might that impact consumer confidence and business confidence, for example? He also has other programs going on, for example, the deportation program, which is a question mark for businesses who might be impacted by that labour source. But of course, on President Trump's side, he would make the point that they're also pushing for lower taxes that will spur investment. They also say higher tariffs will bring manufacturing and investment back to the US as well. So this, and of course raise revenues to offset fiscal deficits. So they're making the case for what they need to do. But I think at the very least, it's a lot of policy change for any economy to manage in a short space of time. And I think there's going to be a lot to assess that's coming at us pretty fast now in the weeks and the months ahead.
We should point out too that of course this was a major part of President Trump's campaign. His pledges to impose sweeping tariffs. He has already ordered up reports. They are due April 1st on overall trade issues and tariffs that could lead him to trigger new levies or to quit the Continental Trade Pact he renegotiated with Canada and Mexico in his first term. That agreement, by the way, is up for review in 2026. One thing I want to ask you, Enda, we filter all of what comes out of Washington through the financial markets. And we did see equity markets take a leg down here on news from the White House press secretary that indeed there would be tariffs forthcoming on Canada, on Mexico, and on China. So I do wonder, the president is also sensitive to what happens in the financial markets. What is the overall thinking within the economic community in terms of how much of it is bluster, how much of it is still campaigning, how much of it is now a real activity? How do you make sense of it? And how much do we think that the president, once he sees some market reaction, might reverse course?
It's certainly a moving target. I mean, to your point, a lot of economists say this is a negotiating tool. Some of President Trump's own officials have made that point. I mean, Howard Lutnick, in his hearing for Commerce Secretary, made the point this week, tariffs can be used for negotiating. Scott Bessent has made that point. So there is a kind of a feeling. Now, critics would say that's complacency among the market watching community because President Trump has made it very clear to the people during his campaign that he's going to go ahead with tariffs and he has the mandate to do so. But then to your point, there is a question, and this is what it goes back to earlier, the point I was making about the economy and the balancing act there. Is there a point where if markets respond negatively, would that put the brakes on President Trump's use of tariffs? This is a talking point among market watchers all the time. You'd have to say, so far, given all the tariff talk since President Trump won the election and come back to office, markets haven't really tossed themselves upside down on this. Certainly not equity markets. There's been bigger moves in currency markets. But if we start to see equities come off sharply over the coming weeks, I think that certainly would add fuel to this idea that there is a break in President Trump's ambitions. But I wouldn't say we're there yet on that one.
It's a good point. Molly, one thing I want to ask you, though, if, a lot of analysis is to also come down that when it comes to tariffs, if it's kind of one big dump and we know kind of what's hitting us, that's one thing. But if it's a constant barrage every few weeks or every month about some new tariffs being levied, that is a bigger toll on the U.S. economy.
Right. And to the point then of as well, what was the real factor in growth in 2019, back when in the first term when this was happening, the broader uncertainty about U.S. trade policy also factors into that like businesses are really just almost paralyzed, in like terms of we just don't know how this outlook is going to evolve. How can you really move forward with investments that are moving on a much longer timeline than what the White House is coming out with every other day? So that really is difficult when you're thinking about how you're going to be making, multi-million, billion-dollar decisions, and you just really have no idea when that moving target is going to hit. Yeah,
I think important to look at the fine print, too, of what happens tomorrow, given that some products could be exempted and, get an understanding for what exactly this is going to hit. Hey, Molly, next week we do have more economic data coming. A real look at the jobs market next week with JOLTS, with the January employment report. The survey says for at least the change in private payrolls, or change in non-farm payrolls, rather, 165,000 jobs added. What's the conversation that you're going to be having around that?
Honestly, the bigger conversation, I keep forgetting that we are getting January data, because the bigger one is more about the revisions to all of last year. So that's really where the conversation is happening. If you remember, we got a report last August. This was an initial estimate of what the revisions might show for payrolls through March of 2024. And that estimate said that payrolls would be marked down by more than 800,000. And that was the biggest downward revision since 2009. That was very scary at the time, and even drew a lot of attention from Congress, which usually, this is a pretty sleepy report for the most part. So that's where a lot of the eyeballs are going to be. The other big thing is we're going to see how the new population estimates are going to impact the household survey. And this is going to be really important to the Trump administration as well, because so much of what has boosted the labor market in recent years has been immigration. And if we start to see that that's really starting to falter off, could really change our understanding of the strength.
All right, Molly Smith, thank you so much. Bloomberg News global economy reporter, and of course out there in D.C., Bloomberg News global economy reporter Enda Curran. Some news from Meta that maybe not surprising, since we kind of see a trend maybe happening.
Yeah, the Wall Street Journal reports that Meta's in talks to reincorporate in Texas or another state. This would not relocate its corporate headquarters from California, but it follows moves that Elon Musk's companies have made as far as leaving Delaware and going to Texas. Again, the Wall Street Journal reporting that news just moments ago.
And we know most U.S. companies, are incorporated in Delaware. So this would be a little bit of a switch against the trend that we've seen for decades. All right, folks, you are listening and watching Bloomberg Businessweek. Carol Massar, Tim Stenovec. More to come in just a moment.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
The nation's biggest office to residential conversion, it is hitting the market with 1,300 apartments carved from a 1 million square foot brick fortress, originally built to house computers and not much else, which means they didn't really care too much about window placement.
No, they didn't. But after a 2-year transformation, the 55-year-old building in Manhattan's financial district, for years it was used to process checks, money transfers, and other paperwork for manufacturers Hanover Trust, and later for back office staff at a company called J.P. Morgan. That building, now, Carol, it's unrecognizable.
GFP Real Estate is one of the developers behind the building. The firm has a portfolio of more than 16 million square feet, focusing on operating property management and development of commercial real estate, in addition to owning, of course. Brian Steinwurtzel is co-CEO and principal of GFP Real Estate. He joins us from New York City. Brian, so happy to have you here with us. This story, we've been a little obsessed with it. Contextualize it for us. How big of a project was this for your team? How difficult was it to make this conversion?
Well, Carol and Tim, thanks for having me here. This is the largest office residential conversion projects in the country to date. We took a 1 million square foot building, basically had to remove all of the brick from the outside of the building, carved 2 light wells throughout the building, and then took all of that floor area and restacked it on top for an extra 10 stories. And what results from that is over 1,300 apartments, which we launched leasing this week, that will include over 100,000 square feet of amenities. And if you're in the building today, there is a rooftop deck, indoor and outdoor pool, co-working, pickleball courts, basketball courts, bowling alley, golf simulators, arcades, pretty much anything anyone would want in a residential building.
Brian, for years, Carol and I have been talking to folks in real estate, especially in the wake of the pandemic when people weren't coming to offices in Manhattan and other cities, but there was also a housing crunch, a lot of affordability issues in cities such as this. How do you make the numbers work here? Because we were told over and over again, it's just too hard to do in most buildings. The windows don't open. The bathrooms aren't in the right place. The plumbing doesn't make sense. It just doesn't work from a numbers perspective. How do you make it work?
Well, we start with an extraordinary team, and the team at GFP Real Estate had just finished building David Geffen Hall for Lincoln Center. And we brought on Setchel Ruddy, which is one of the top firms that does this kind of work. And along with our partner, Metro Loft, assembled a team that included over 1,000 people that have touched this project in order to make it happen. New York City, unfortunately, has suffered a distressed commercial office environment, but we are looking to make lemonade where there's lemons. And so we bought this building from the lenders and from the prior owner, and we brought on a capital partner that was willing to take the risk to do this. And with that team of over 1,000 people have created this project.
And you guys got a $536 million loan for the acquisition of the building, its existing debt and the cost of conversion. So you did this. Is it fully, give us an idea of occupancy, what you were seeing, give us an idea of the interest in the building.
So the financial district has done extraordinarily well over the last decade. I actually lived in the financial district in 2004, and the neighborhood is completely different. Today, there's tens of thousands of residents that live there, and every day there's more and more that are coming in. The big building has a big capitalization, but the absorption in this market has been nothing short of extraordinary. There were 2 buildings that opened up recently in the last year. Both of those are one of them is completely full, and the other one is almost full. And our anticipation, just based on opening on Wednesday and the number of tours and inquiries we've had, which is in the hundreds, that we will lease very quickly.
Can you say how quickly?
Well, I think for GFP Real Estate and our partners, we're very conservative in our assumptions of how long.
Yeah.
But our hope is that by the end of next year, we'll be entirely leased.
Does this create some sort of new blueprint for how you move forward with conversions? Is that what's next? Are you interested in converting any more buildings? How are you thinking about the path forward right now?
Yeah, so including this building, we have approximately 3,000 units that are in our pipeline that we're creating. So we have several other projects that are coming down the road and will be completed. And I think what's helped us be successful is a partnership with the city and state, who recognized early on in the pandemic that this was a major issue and that they had to sit with industry and come up with a game plan for us to take these distressed office buildings and create housing out of them. And so there's a program called the 467M program that the mayor and governor both put into law last year, and that has helped become an accelerator for getting these kinds of buildings done. And we are, along with our partners, fully invested in these programs.
Hey, one of the things, though, you obviously got through it all. What was, though, the largest hurdle to overcome with the office to residential conversion of this size and scope?
It's a great question, and I'd say there's it feels like a largest hurdle every month when you're in a project of this magnitude. But this is a very complex building. It was designed to look like an IBM punch card. And the way they made the punch card lines is they actually had the facade and each floor jut in and out at different times on every different floor. And one thing that we made a decision on early on in the project is we wanted to actually carry forward that architecture, but at the same time have new window wall throughout. And so one of the most difficult things was we actually have the window wall custom made, and it comes in and out on each floor, and that architectural feature can still be seen from the inside and the outside of the project. But doing that and preserving that work was one of the most difficult parts of this project.
But you knew you wanted to do it, right? It wasn't just because you had to, you wanted to. Is that fair?
Yes, it is. I think every project that we take on, and the majority of our portfolio are historic buildings, we are looking to preserve whatever can be preserved, especially the most important elements of that project.
Yeah.
And even if it costs a little bit more or takes a little bit more time to do it, it's an important part. And I think the residents that will live there will see that and feel good that this was preserved.
Do the economics of this only work when you create them for rentals, or would it work for sales as well?
I think the hard part with sales is a building of this size, you have to do so much condo sales that it's more suited towards rental. That being said, there are a number of other conversion projects that are condo. Our organization has owned the Flatiron building with partners since the 1990s, and that building will be turned into a condominium building. But that building has only a few dozen units. And so it's really a different scale and magnitude.
Hey, Brian, just quickly, got 30 seconds left here. Our team, our Sonali Basic, catching up with Blackstone President John Gray, and I think members of our team also talking with him. He said they're the world's largest commercial property owner. He said the worst is over for the global office market after a prolonged slump fueled by the pandemic. Just got 25 seconds here. Do you agree?
Oh, I certainly hope so, and I would agree. So GFP is the largest landlord to small and medium-sized tenants in New York City, and I think for a while now we've seen positive absorption and tenants returning to the office. I think that he has it right, and I hope that continues.
All right, great to check in with you, and hopefully we can do so again in the future. Brian Steinwurtzel, he's co-CEO and principal of GFP Real Estate, joining us here in New York City.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
I don't need to tell you this, but there's a lot out there for CEOs to navigate right now. We got breaking news from the White House on tariffs. We've been covering that this afternoon. Not to mention the new administration in the White House, their priorities, geopolitical threats, technological disruption from AI, and more.
Yeah, there is so much. Sharon Marcil is CEO of Boston Consulting Group, hears regularly from chief executive officers from the C-suite, and she joins us right now from Raleigh-Durham, North Carolina. Sharon, good to have you here with us. You are just back from Davos. Our team, too. We've all been kind of talking about what was talked about, what was top of mind, what was concerns. Two of the things that I heard, it was President Trump and artificial intelligence. What did you hear?
Yeah, Carolyn, Tim, thanks for having me. I really appreciate it. And exactly right. Just back from Davos. I'm Sharon Marcil. I'm the North America head of BCG, the Boston Consulting Group. So, this is my third year at Davos. I think each year you get a bit more out of it. And, I was struck by a few things in terms of Davos. I think number one was the optimism in terms of the business growth orientation. And I think that's, of course, particularly true in the US and then in Asia, less so in core Europe and in places like Canada and Mexico when you spoke to some of the uncertainty there with respect to tariffs. But there was, a good sense of optimism. I think the other...
Can I jump in for a second? Because I'm just thinking, what is the story that's dominating on this Friday? And we're all trying to put some context around it. But we do have President Trump intending to move ahead with plans tomorrow to impose 25% tariffs on Mexico and Canada, a 10% levy on China. The White House has confirmed this. And this could be just step one in more tariffs to come, perhaps, on other nations. We know that has been certainly some broad expectations ahead of Donald Trump coming into the White House. How might this news, if it was out before Davos, maybe impact some of that optimism?
I think what was anticipated at Davos was there would be tariffs. I think that was a promise during the presidential campaign. And I think that was anticipated. I also think that, when we did a survey of companies from around the world, 85% of companies have a plan in terms of how to deal with it. Now, it's a plan which is very much in flux and lots of different scenarios because it's not known exactly when it will come, exactly what it will look like. And so I think those scenarios are very fluid. But I do think that versus in previous times, I think there has been a lot of planfulness in terms of preparing for what might come.
One thing that I've been pretty surprised about over the last couple of weeks has been the changing tone that we're hearing from U.S. companies about this administration and their willingness to really embrace it. And I'm wondering what you're hearing behind the scenes from CEOs about that. Is it really is it really purely the cost of doing business? Is that what it's seen? Or are they seeing this as embracing a fundamental shift in America right now?
Look, I think if you talk to business leaders, they're positive in terms of some of the economic signals. Now, those signals, aren't brand new. They're coming from 2024 and before. And I think there's optimism about the pro-growth posture of the administration. So I don't know how much there is really new, but I think there will be greater investment in the U.S. I think that's seen as a positive. I think there's there may well be a lower tax regime, which could be positive in terms of actually investing more in R&D, investing more in the business community, and also for returns. And so I think there's reasons for positivity, but I don't want to underplay. There's also a lot of volatility and a lot of which is unknown that I think business leaders are preparing.
Well, Sharon, just give us an idea of who some of the business leaders you spoke to at Davos were. We like specifics here.
Well, from a range of industries. I mean, I spoke to people from the pharmaceutical industry, people from the tech industry, people from the aviation industry. So it was really a wide range of industries. No one sample set. No,
can you give us any names?
I can.
Gotta ask.
But you did say that there was optimism, and I guess what I do wonder for CEOs, Sharon, is that, as you said, they expected tariffs. We were kind of surprised on Donald Trump's first day or even 2 days in the White House that we really didn't get anything specific on that front, because I think everybody expected that to be the first thing out of the gate. Having said that, is for the C-suite, even if 25% tariffs can be on Mexico and Canada, and who knows what might come, might be onerous or problematic, knowing what you are dealing with rather than the unknown, is that better for the C-suite or not necessarily?
I think you're right. I think it's better. And I think when you know what direction things are heading in, you've done all the scenario analysis, you have tentative plans for which direction you can head in, but you're not going to put your dollars at work until there's greater certainty. And so I think as there is greater certainty, whatever direction that heads in, I think it will open up the aperture in terms of investment.
I think one area that we've been obsessed with over this last week has been AI, and really trying to understand the way that the narrative was rewritten or could be rewritten as a result of what we saw from DeepSeek. And I know that was a big part of the conversation at Davos. In your view, when are you going to start to see companies that are not actually in the AI space start to increase their bottom lines as a result from this technology?
I think that's a great question. And I think that was actually the question at Davos. And there was a lot of great discussion. Look, a couple of years we've been talking about AI, and the business community has been very excited about AI. And I think what's encouraging is those conversations are moving from hype and experimentation and use cases. We're doing 25 use cases over here and 35 use cases over there, to actually, where are we going to get tangible value in the core processes in our business that actually drive competitive advantage? In fact, in 2024, BCG did a survey of executives, and we found that 2/3 of AI transformations were falling short of expectations. But we're finding with our clients and in the conversations at Davos that are succeeding, it's because they're focusing. They're focusing on the areas of the business that they can transform and, again, create competitive advantage versus lots of areas around the edges. And we like to say, look, you can get the algorithms. That's 10%. You can get the tech stack. It's important, but it's 20%. But what you have to be able to do is get the processes and people and really scale the transformation. So we call it 10-20-70. And I think that's a place where companies, clients, the folks in Davos are leaning into. Where can we really scale and get competitive advantage?
Hey, before we go, just got about a minute left here, Sharon, and I do wonder, going back to, or just focusing once again on Davos a little bit more, is the corporate community breathing a sigh of relief that even though Donald Trump, many would say President Trump, is unpredictable or can be unpredictable in terms of what we get from him, and sometimes at unexpected times or unexpected places, that they expect it to be an easier regulatory and very business-friendly environment. So they're willing to kind of put up with some things because they think the overall policies will be much more friendly to doing business in the United States. And just got about 30 seconds here.
Sure. I think there's a couple of, the economy is strong, right? So I think that's a core input. And I think if you think about this current administration, I think some of the policies that Donald Trump campaigned on and was elected on are a little bit more pro-growth oriented. And I think that, the business leaders can see some of those policies and regulations as being advantageous in terms of the growth of their business and the opportunity for investment.
Even tariffs, just 10 seconds. They thought tariffs were growth oriented?
I think tariffs are a mixed bag.
Okay.
I think tariffs are a mixed bag. But I think other policies that the administration is advocating are pro-growth oriented.
All right. Great to get some time with you and to share what you saw and heard at Davos. Sharon Marcil, Chief Executive Officer of Boston Consulting Group North America, joining us from North Carolina.
This is the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, everybody, just got about 18 minutes to go until we wrap up the trading day and the trading week. Carol Massar along with Tim Stenovec live here in our Bloomberg Interactive Broker Studio, live on Bloomberg Businessweek. Just a reminder, we are anticipating at the top of the hour in an update and briefing from the NTSB looking into that investigation to Wednesday's midair collision at Reagan National. So as soon as that begins, we will take you there live for the latest on that. In the meantime, got to talk about the markets because a lot of news coming out of D.C. And really top of mind right now, Tim, is what we are anticipating at this point, tariffs that go into effect tomorrow
I knew you were going to say tariffs.
The chief trading partners with the United States.
Yeah, that would include Mexico, Canada, those 25% tariffs, and then 10% tariffs on China. Sean O'Hara is president at Pacer ETFs. They got about $47 billion in assets under management. Sean joins us from West Palm Beach, Florida this afternoon. Sean, good to have you with us. We did see stocks take a leg lower after the White House said during the press briefing that those tariffs would begin tomorrow. How are you looking at the policies that have been enacted thus far, or at least been talked about thus far by the Trump administration?
Good afternoon. Thanks for having me. It's nice to be with you both. I think there's some good and some bad, if you will, or some that are appealing to investors, and then some that make investors a little nervous, which is probably why this information or news on tariffs is sort of causing a little bit of stress in the market. Overall, if you take the president at his word, he's going to reduce regulation, make it easier for businesses to do the things that they do. I think that's generally a positive. He's definitely got to focus on America first. I think that's also generally a positive. So as all of these policies sort of tend to roll themselves out, we'll get a clearer and clearer picture. My own personal view on the tariff side is I think we're making a lot out of something that may not ultimately mean that much in the long run. I think the president uses tariffs as a way to negotiate, if you will, to get people to do the things that he thinks they should do that would benefit Americans the most and benefit the American economy the most. But I think you got a little bit of a mixed bag going on. Some good, a little bit that makes us nervous, I guess, or at least makes the market nervous.
So, Sean, what do you make, though, of really the pushback, what seems, on ESG, which has been actually happening, I would say, certainly here on the financial side of things for a while now, but even on DEI, diversity, equity, and inclusion, the pushback on those policies. How do you square when after I feel like it's been years and years and years that consultants, McKinsey and others have talked about the importance of diversity from even a financial level, that diverse boards, companies that are diverse in terms of their approach and their composition, that they financially do better. Was that just all lies?
Well, I mean, I guess that's what you get when you ask McKinsey consultants how you should run your business. Just a little poke at them maybe within their 26-year-old MBAs. I think generally speaking, if you run a company, you should run a company for the benefit of your shareholders first. And I think that it couldn't happen soon enough, in my view, that we sort of have shifted some of these things off to the side. I think that's a net positive for companies. One of the things that we need in this market and that American companies need is productivity growth. When you have programs that sort of potentially stunt that productivity growth or an additional expense line item in terms of how they run their business, then that sort of stunts productivity. And so we never were real big believers in ESG or DEI. We never, followed all the big ETF issuers into the ESG to try to get the big institutional, assets under management. We just focused on trying to find strategies in our ETF lineup that were really focused on fundamentals that were good for companies that would hopefully over time make those companies more valuable and see their stock prices rise.
So in terms of, you said we kicked it off talking about the second term of Donald Trump in the White House. You said some good policies, some bad policies. The most read story in the Bloomberg has to do with these tariffs that are coming on China, Mexico, and Canada, right? And they are expected to go into effect tomorrow. 25% on Mexico and Canada, 10% levy on China. Is that in your good, bad column, in the bad column, in terms of the possible impact on companies and the U.S. economy and ultimately on U.S. publicly held companies?
I didn't put it in my bad. I put it in my unknown category. We'll have to see category. I think generally.
Why unknown? Yeah.
Well, because I don't think we really know what the ultimate tariffs are going to be, or if there are actually tariffs that last. I mean, everybody needs to keep in mind this is the second time that President Trump has been president, and the first time he wasn't very different in terms of how vocal he was about tariffs. And in spite of all of that, the markets did just fine and the American economy grew. And so I think he's focused on the tariff side because of all these trade deficits. In other words, we shouldn't have trading partners where we're as unequal as we are. I'm not sure we'll ever be equal on the trade side with China, but we should do what we can, if you will, to make sure that the American companies that are exporting outside of the U.S. have an equal chance. And so I suspect that we're not going to see, 25 or 30% tariffs on Mexico or Canada. They might meet somewhere in the middle, or they may recraft an overall trade deal that makes them not necessary. So I just think we need to wait and see and be a little bit calm. I know that, it's one of those things that we talk about or that some people talk about on the air all the time, and it makes everybody nervous. I would just say with regard to that, let's just pump the brakes a little on the hysteria there, and let's wait and see what happens and what the outcome is.
Well, you have dozens of ETFs at Pacer, including those that are you categorize as risk mitigation, high value growth, thematic growth factor, structured outcome, and income. Where are you seeing the flows right now as far as money coming in? Where are people putting their money?
It's a great question. The biggest flows for us are coming into an ETF. The ticker's CALG. It's our growth, like twin sister or brother to the CALZ value story. We used free cash flow margin. That's a simple calculation. It's the sales a company gets divided into the free cash flow. So it's just a measurement of how effectively companies convert their sales to profits, and the higher that free cash flow margin, the more effective companies are. What's fascinating, and I think what's leading to some of the inflows, is that if you look at, say, CALG versus the NASDAQ 100 or the Russell 1000 growth, we're performing as well or better over the last couple of years than those two big indexes, with one major distinction, which I think is important, and that is that we only have 17% overlap to the Russell growth and only about 17 or 15% overlap to the NASDAQ 100 in terms of portfolio names. But we only have 4% of the portfolio weight in the Mag 7 names. And so one of the things that we're talking to advisors and investors about is that what once was designed to be diversified is not necessarily as diversified as you think, based on the way the markets performed the last couple of years. And potentially one of the biggest risks to investors is that overconcentration, as much as has made us feel great on the way up, could be ultimately as disappointing on the way down. And so we're not saying, sell all your Qs or sell your IWF, which is the Russell Growth ETF. But what we're saying is, you should recognize how concentrated and dependent you are to a very small number of names, and perhaps find a different way to do that.
Yeah.
And when you use free cash flow margin as your screen, you wind up owning names like Apple, which is in the Russell Growth, but only a very small weight.
We got to run. Have a great weekend. So glad we got time. Sean O'Hara, president at Pacer ETFs. This is Bloomberg.
This is the Bloomberg Businessweek podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.